Hey guys, Britt here. Welcome to End Times Bible Prophecy. Make sure to hit the subscribe, like, share, and restack buttons. Well, today we're going to talk about 3 reasons why we're on the verge of the greatest financial crisis of all time. But first, I want to turn your attention to this. If you saw the video we put out yesterday about Nelson and Heather Sweetman and the flooding they experienced at their house in North Carolina. Many of you know Nelson from the comments section on many of these different platforms that this channel is posted on. Guys, the prayers were answered. God moves in amazing ways. So in the past 24 hours, not even quite 24 hours since that went out while I'm recording this, over $20,000 has been raised. Guys, this is just amazing, and it appears God has answered the prayer that, well, come Christmas, they'll be able to watch this movie in their home. I heard from Nelson just a few minutes ago, and he said that they believe they will be back in the home after Thanksgiving. No floors, but they'll have heat. They'll be in their home and not displaced from their home. Guys, that is good news. Guys, God knows our needs. He gives good gifts to his children. And we live in a world that's filled with bad news, right? We cover a lot of that. But there's still a lot of amazing things that happen. God's hand is still at work in the world we live in. He has achieved victory over this world, despite the trials and tribulations we face. And guys, this community that watches this channel, that interacts here, all of you in the comments, guys, this is a family that looks out for each other, that is exhibiting and showing the love of Christ and being a light to the world. And that's what's just so amazing. I'm at a loss of what else to say other than thank you for your generosity, your kindness. Again, beyond the financial giving, I know everyone who saw that said, I'm praying for Nelson and Heather. And guys, that's just amazing how much this community that watches this channel rallied behind 2 of our own. So thank you for all that you've done. So 3 reasons we're on the verge of the greatest financial crisis of all time. Well, the first one that I want to talk about has to do with the fact that we are in a stock market bubble. And guys, we're not just in a stock market bubble. We're in the greatest stock market bubble of all time. I thought that was a couple of years back and the market had declined, but given the rally of the market, we are now in the most overvalued stock market of all time in the United States. So here we have this tweet from Bar Chart. Says Warren Buffett indicator hits 199%, the highest level in history, surpassing the dot-com bubble and the global financial crisis. And this chart's a little bit blurry. I wanted to make it bigger, but with the colors that are used, it's hard to see. So let's pull up this site, which has the Buffett indicator. Now, you'll get different raw numbers. That one said 199%. It depends on when they do it. This one, it looks like, is updated through August 31st, so it has a different value, plus they might use the Wilshire 5000 versus a different index. But no matter what index you use, it's the most overvalued it has ever been. So they come up with a value of 209%. But we can see on data going back to 1950, just how overvalued this is. Again, this is the dot-com bubble and how much higher the market is right now. As we've never seen levels of overvaluation this big. How about this. So we had this tweet from Lawrence Lepard. He says, for anyone who does not think the stock market is extraordinarily overvalued based upon all of the, quote, free money that blew this everything bubble, I'll just leave these two charts from John Hussman below. And this other one, this one's a little more complicated. We're going to stick to this one because I think it makes it very clear. So this is basically saying what are the expected 10 to 12 year returns based on current valuations. In other words, if the market's undervalued, your returns going forward on an annual basis will be higher than if it's overvalued, where they would be lower. And so the higher this graph is, the worse off it is. That means the more overvalued it is. His data goes back past 1950 to 1928, and we can see the 1929 market peak up here. We see the dot-com bubble here. We see right before the great financial crisis here. And we are here as of October 14th. So guys, this could go higher and become even more overvalued. But all of this is telling us we're at extreme overvaluations in the stock market, and that makes us more susceptible to seeing a crash, as we saw in each of these previous instances. Again, we saw a crash in 1929. We saw a crash particularly in the NASDAQ. I believe the NASDAQ lost over 80% of its value from peak to trough during the dot-com bubble implosion. That was over a 3-year period. The same is true of 1929. We tend to think stock market just crashed in a day in 1929, and there was a big crash known as Black Monday that sort of kicked things off. But it took 3 years to bottom, and from during that time, peak to trough, it was down 90%, or I guess 89% technically. Well, when you're talking those numbers, it doesn't make much difference. And then, of course, the great financial crisis. We saw a crash. It was around 50% on the S&P 500. So guys, we're setting ourselves up for another crash like that. And there's more data indicating this. If we look at this tweet from Mike Investing, he says, breaking news at the peak of the dot-com bubble, Cisco was worth 5.5% of US GDP. To put that in perspective, GDP is supposed to represent all the goods and services produced in the US economy in total, so all the total production. And at the peak of the dot-com bubble, Cisco, one company that made internet routers, had a valuation equivalent to more than 5%, 1/20th of all the economic output of the United States. But today, NVIDIA is worth over 11.7% of the U.S. total economic output. I want you to think about how absurd that is. When this bubble pops, and it will lead to a collapse bigger than 2008. It's only a matter of time. And here we see this right here. So this puts it in perspective. So this white line was Cisco's valuation. And we see it was a big bubble. It burst. Doesn't mean that the company wasn't a valuable company, that it wasn't contributing to society. It did, but the expectations of what it would provide got way far ahead of what it actually did provide. The same is going to be true of NVIDIA. It's impossible to meet these expectations by the market for what NVIDIA can do. And therefore, it will inevitably burst like all of these other bubbles. So guys, we're in a massive stock market bubble. That's number one reason we're on the verge of the greatest financial crisis of all time. So I believe that crisis has been unfolding since the summer. Again, we saw the largest two-day fall in Japanese stock market history back in early August. I believe the financial crisis kicked off in the 2 or 3 weeks leading up to that. We still have an elevated U.S. stock market at all-time highs, the most overvalued in all of history. We also have a banking system on the brink of insolvency. No doubt about it, we have big trouble in the banks. That's the number 2 reason we're on the verge of the greatest financial crisis of all time. Again, we've looked at this chart numerous times. This is government data from the FDIC of U.S. banks and their unrealized losses on the securities they're holding. So this is treasuries, U.S. government debt. So yes, this is supposed to be safe, right? And yeah, the government will pay it back over time, but what's the value of those dollars they're paying back, for one thing? But even if you think they're normal, a lot of this debt was purchased when the interest rates were 1 or 2%. And so when interest rates went up, the value of those holdings went down. And again, this little blip here is the great financial crisis that almost destroyed the world economy, we're told. And yet, this is where we are right now. This should underscore why we're headed straight for the greatest financial crisis of all time. We looked at this last week, but I think it's worth reiterating. This is from MarketWatch. It says market bracing for $1 trillion bill on commercial real estate coming due through 2025. Again, this is going to hit the banking system hard because the banks are the ones ultimately left holding the bag for these losses. It says more than $1 trillion of commercial mortgage debt will need to be refinanced through next year, according to a new Moody's rating report. That's nearly 20% of all outstanding U.S. commercial mortgage loans. The Federal Reserve's pivot to interest rate cuts in September has stoked optimism about commercial real estate and helped improve financial conditions, but there's a host of issues, including remote work, still high interest rates, which we're going to address in a moment, and a slowing economy that all add to the risk associated with refinancing these properties. And again, we mentioned 87% of these properties are on interest-only loans. For 5-year terms, they need to be rolled over and refinanced. Guys, let's take a look at one of those properties. I don't think we've looked at this one before. Correct me if I'm wrong in the comments, but this is from back in August. It says a 345,000 square foot office tower in Baltimore sold for $4 million, or $12 per square foot. And we looked before at one in July in Manhattan. Prime real estate, prime location, sold for over, I think it was 200 million plus back in 2006, and then 8 million in July, a 97% decrease in 18 years. And guys, when the people who took out these loans, when those companies walk away from these properties, they might have put 20% down originally, maybe more. But they're saying, we're willing to walk away from that and realize that loss rather than put up more cash for something that's not cash flowing. So these properties end up just going back to the bank. And so when you talk about it sold for $4 million, that means whatever bank took possession of this from the company that defaulted on the loan the first time, this is what they were able to sell it at auction for, was $4 million. So they booked, some bank somewhere logged a massive loss on this property, and we're going to see 20% of these properties coming back up for refinancing in the next 12 months. And losses are going to be booked by so many banks. And again, let's revisit this. This is a press release put out back in June from the College of Business at Florida Atlantic University about the risk of bank failures as a result of the commercial real estate crisis. And it pointed out that banks with exposure to commercial real estate greater than 300% of their total equity are at greater risk of failure. It says bank regulators view any ratio over 300% as excess exposure to commercial real estate, which puts the bank at greater risk of failure. And as of June, 1,871 banks met that criteria. And there were 243 that were twice as worse, 600% exposure. So because the banking system has massive problems, it can't be bailed out forever without consequences coming up somewhere else in the economy. They can bail the banks out forever by simply printing dollars and handing them over to the banks so that the banks never fail. But that's going to cause massive problems in another area of the economy. Eventually the bill comes due and you have to pay it. There's consequences for actions. And this discomfort that we're trying to avoid in the economy, eventually it's going to happen. Free market forces will assert themselves. So guys, that's 1 and 2. We have the greatest stock market bubble in human history right now. We have banks under pressure all over the globe. It's not just the United States. From commercial real estate losses, from their bond portfolio having unrealized losses. There's so many issues with the banks. And guys, the third reason we're headed for the greatest financial crisis of all time is probably the worst one of all. And that's because we're seeing a bubble, not in real estate, stocks, bonds, but in currency itself. Fiat currency, meaning the dollar, the euro, the yen, the pound. Every currency on the planet is a fiat currency, meaning its value is derived from the fact that the government says it has value. We printed this piece of paper and we say it has value. The free market's going to say otherwise, and it is. And that's going to lead to the biggest, greatest financial crisis the world has ever seen. So let's take a look at this right here. So this is the U.S. 10-year Treasury. So this represents when the U.S. government wants to borrow dollars, they hand over this 10-year Treasury to someone, and that person, usually a bank, gives them cash, gives them dollars for 10 years at a rate that's determined in the marketplace right now to be 4.21%. Now, this is the benchmark rate that typically establishes what mortgage rates are pegged at. So it's an important rate. But what's noticeable is what's happened recently. So if we look at this chart, we'll notice that back on September 16th, we saw a low in the 10-year rate of 3.618%. Why is that important? Well, the Federal Reserve came out and cut interest rates 50 basis points or half a percentage point on September 18th. And so what has happened since the Federal Reserve came out and cut rates on the 18th? Well, you would expect that rates would go down since they cut rates, but rates have not. Instead, they've gone up. So we now see rates at 0.6 percentage points, or 0.6 of a percentage point higher than they were before the rate cut. So what does that tell us? Well, let's see what people in the media are saying, and then we'll talk about what is the real answer. Right? It says, this is from Zero Hedge. It says, when Powell cut rates by an emergency 50 basis points, did he expect yields would be 50 basis points higher a month later? Says, when the Fed cut rates by only an emergency 50 basis points on September 18th, because usually they don't cut that much unless there's something wrong, which again, there is. They know that. As it Orwell style said, the US economy was good. I wonder if their army of market economists had warned them that just over a month later, the 2-year, so it's not just the 10-year, but the 2-year and the 10-year US Treasury yield would both be trading 50 basis points higher, and with market chatter that they could be even higher in the days ahead. And if they did, why did the Fed cut when they wanted to see lower yields? Well, we talked about, again, let's go back and look at this. This is the result of interest rates going up. So if you can get the interest rates to go down, then this will all push back up here and become more normalized. The problem is, it's not working, right? The central bank cut rates and it's not working. They're trying to bail out the banks because they know we're on the brink of a systemic banking crisis. So that's why they cut rates in September. But instead of helping the banks, looks like it might make it worse for the banks. How about this? This is from CNBC. It says the Fed slashed interest rates last week, but Treasury yields are rising. What's going on? Despite the Fed approving a 0.5 percentage point reduction in its baseline short-term borrowing rate, Treasury yields have been moving higher, particularly at the long end of the curve. So that means the longer you go in duration, meaning there are 30 years, the government will borrow for 30 years. They call that a 30-year treasury, or for 10 years, that's the 10-year. So for those longer durations, the rate's going higher, and that's the way it should be. You need to be compensated for the risk of not being paid back at that time, plus inflation. But it says, for now, bond market professionals are writing off a good portion of the move as a simple makeup for markets pricing in too much easing before the Fed meeting. However, some experts interpreted the Fed's focus on supporting the softening labor market as an admission they're willing to tolerate a little higher inflation than normal. Let me tell you what's really going on, guys. The government, the United States government, is engaged in out-of-control spending. We all know it. And we're supposedly in this great economy with record low unemployment. Everything's wonderful, but we're running these multi-trillion-dollar annual deficits with interest on the national net debt now being 1.5 trillion per year and growing. And they can try to demand that interest rates are lower so that that cost will come down. But the market says, no, the only way you can meet these obligations is to print dollars. And every time you print dollars, that devalues the purchasing power of those dollars, called inflation. We all see it. A dollar buys less at the grocery store than it used to. So we know you're going to print these things. If you want me to lend you dollars for 10 years or 30 years, you're going to have to pay a much higher rate than what you're paying. The Federal Reserve is losing control of its ability to manipulate these rates. And guys, that's a big deal because many of the participants in the stock market and elsewhere, they've attributed these godlike powers to central banks to be able to fix any of these problems in the economy. We don't have to worry about the stock market crashing. The Fed will come to the rescue. We don't have to worry about banks failing. The Fed will come to the rescue. And in the past, they have. But the Fed's trying to come to the rescue right now. It isn't working. Let's take a look at this right here, this tweet. It says, breaking news, Druckenmiller, this is in regard to Stanley Druckenmiller, the billionaire investor is shorting U.S. treasuries with a record-setting 20% of his entire portfolio. Because he knows what's coming. It's basic math. It says there is a second wave of interest rate rises coming, which is exactly what happened in 1968. He knows what's about to happen. So, what's about to happen? Well, we're about to see the Fed lose control, and we're about to see what happens when market participants realize that their faith in the Federal Reserve and central banks is misplaced, and that they don't control it all, and that free market forces will reassert themselves. Let's look at this tweet by Porter Stansberry. He says, the bond market is revolting against the Fed. This morning, yields on the U.S. 10-year bond soared over 4%. This continues a non-stop rise in yields following the Fed's 50 basis point rate cut in September, on September 18th. Normally, long-term rates follow the path of interest rates in the overnight lending market, which the Fed directly controls. But this isn't a normal environment. He says, whoever believes our economy is strong must think borrowing unsustainable amounts of dollars, printing dollars to pay for those loans, and then hiring people to do wasteful government jobs is the path to prosperity. It isn't. The United States government is running deficits equal to 6% of GDP and only generating 3% economic growth. In other words, if you remove government spending from the equation, America's economy is shrinking. We are on our way to a Soviet-like collapse in our economy as more and more of everything we do, including our jobs, are controlled by the government. Mr. Market, meaning the free market, is starting to sniff this out. That's why investors are dumping treasuries, flooding into gold, stocks, and real estate at record high prices. Meanwhile, we're witnessing an entire presidential election campaign without either major party bothering to address the single most important issue at stake in our country, according to him, but it is an important one: America's unsustainable debt burden and the coming insolvency of the federal government. It's only a matter of time now until one day the U.S. Treasury market suddenly realizes that no amount of printing will stop the collapse. There will be no bid for our country's bonds. And he's right, guys. This is the end game for the global fiat monetary system. It's the end game. They've been printing dollars, spending them, causing inflation. And that inflation is likely possibly to spike here, as he points out, but I would say it's only going to spike for so long when people can't afford to purchase things, they won't be purchased. And then the economy will go into that contraction. When that happens, then you have the deflationary spiral. And what that means is, let's say, let's put it in these terms. Let's say you sell cars, right? We manufacture cars and sell them, and they're $50,000 a piece. And the people who buy those cars typically cannot afford to buy those cars. Even if the financing is available, they do not have the ability to make those payments because all of their income is eaten up paying for groceries, just trying to survive, much less buy a brand new car. And so those cars don't get sold. And what happens when those cars don't get sold? Well, workers get laid off. And when workers get laid off, well, they can't afford to make their debt payments. When they can't afford to make their debt payments, they don't make their debt payments. And so this ripples through the economy, and you see business failures, job losses, business failures, job losses. And that will create massive deflation, not inflation. But what's going to happen is when that happens, all of these government subsidies kick in. You have lower tax revenues for one when that's happening, which makes the deficit even bigger. More and more people on food stamps and other government programs, again, makes the deficit bigger. And you have a collapse in faith in the dollar, the euro, the yen, the pound, every fiat currency while you're contracting. I mean, this is this is going to be terrible, guys. We're going to see this deflationary collapse, and in order to stop that, the governments will kick the printing into overdrive. So again, we're going to see, we'll hear more rumors of inflation, but in the short term, I would be more concerned about deflation and business failure, job loss. And then to counter that, the governments will go on one last spending spree that will completely destroy their currencies, the value of their currencies in the market, cause hyperinflation all over the globe. That's down the road. It's not immediate. The immediate threat, I believe, is deflation. But guys, that's where all of this is headed. This is going to lead to the greatest financial crisis ever. As we pointed out here in this article in the Substack, How the Current Global Financial Crisis Leads to Biblical Tyranny in 10 Steps, talked about what the United States is seeing now, where they cut rates and they actually go up, is something that Japan has faced in the past. And what they did was they said, well, we'll just print yen to buy that government debt in order to drive the interest rate down. But eventually, that doesn't work anymore. And we're at a point where Japan, no matter what they do, they raise rates, they lower rates, doesn't matter. They're at the end of the road. And the United States is reaching the end of the road as well. All of these every economy in the world is reaching that end of the road. We're coming to a moment where we've already talked about China is in deflation. Germany is in deflation. Those are the second and third largest economies in the world. Japan is the fourth. And no matter what they do, they're going to be in turmoil. And the United States is tipping over into deflation, in my opinion, and particularly once we see the stock market bubble burst from these levels, we're going to go into economic downturn akin to the Great Depression. And its severity, it will be as bad as the Great Depression. We've talked about before, I do not think it will last 10 years like the Great Depression did. It will be 12 to 18 months, and they'll seemingly end it by simply printing cash and handing it out to every citizen. Oh, well, people can't afford their groceries. Here's a stimmy check. Oh, people can't afford their rent. Here's a stimulus check. People can't afford their cars. Here's a stimulus check. Over and over and over. Until eventually what happens is, well, then they go, Well, the price of groceries has doubled this month. We need to double the stimulus checks, not realizing that the stimulus checks are the reason that the grocery prices doubled. And so they'll continue down that path. There will be this brief moment of time in the aftermath of that severe depression where things seem to return to normal. And then the hyperinflation will kick in. The whole thing will come to ruin. And that's when, again, they roll out their new system. Central bank digital currencies, tokenized assets, digital IDs. We may even get to that point before, probably will get to that point before the hyperinflation. Whatever it is, they're going to push us into this system, guys, because we're on the verge of the greatest financial crisis of all time. So guys, let me know what you think. Maybe I'm crazy. Leave your comments below. Make sure to hit the like, share, subscribe, and restack buttons. Again, thank you for all of your help and kindness, generosity toward Nelson and Heather. But let me know what you think. Leave your comments. And God willing, I will see you on Monday. Bye. If you want to learn more about the end times and Bible prophecy, make sure to visit my Substack at brittgillette.substack.com. There you'll find my latest videos and articles, as well as notes, where I share the latest news headlines, the articles I'm reading, and the videos I'm watching. Subscribe for free, and each new post on Substack will be sent directly to your email. Just scroll to the bottom of the homepage and hit the subscribe button. As an added bonus, your first welcome email will include a link to a copy of my free ebook, 7 Signs of the End Times. Also, make sure to check out all of my books. Just look up Britt Gillette on Amazon, Barnes & Noble, Apple iBooks, Google Books, Kobo, or anywhere books are sold. Thanks for watching today, and until next time, keep your eyes fixed on Jesus, the author and perfecter of our faith.